Welcome to Spiedel's Federal Tax Minute. I'm your host, Catherine Zidane, and this week we're discussing Homeowners Association dues and assessments and when they're deductible. Spiedel's 2024 Summer Tax Webinar provides a mid-year refresher on topics tax professionals are asking about. Topics covered include maximizing business tax credits, understanding the tax treatment of rental property, beneficial ownership reporting requirements, and more. Sign up for morning or afternoon sessions at spiedel.com under webinars. Homeowners associations, or HOAs, are membership organizations formed by real estate developers and generally own and maintain the common areas, streets, and sidewalks and enforce rules to preserve the appearance of the real estate development. HOAs are tax exempt as social welfare organizations if they're operated for the benefit of all the residents of their community. The main purpose of an HOA is the maintenance of common areas, and regular dues generally serve that purpose. Whether HOA dues are deductible depends on whether regular maintenance of the property at issue is deductible. For example, regular maintenance expenses of a personal use residence are not deductible, so HOA dues on such a residence are likewise not deductible. Regular maintenance expenses on investment, business, or rental properties are deductible. As such, HOA dues are deductible if they apply to these types of properties, subject to the same limitations as other regular maintenance expenses for that type of property. For example, in the case of a home office, HOA dues are treated as indirect expenses, and for vacation rentals, they're allocated the same as other regular repairs and maintenance costs. HOA special assessments are charged to pay for extraordinary repairs or capital improvements, possibly due to a disaster or other similar event. Special assessments have to be added to the home's basis and can be depreciated for investment, rental, or business properties. HOA dues are prorated on closing statements and are not part of the selling expenses for the seller, nor are they included in the acquisition cost of the property for the buyer. For rental, investment, and business properties, prorated HOA dues should either add to or reduce deductible HOA dues on Schedule E or Form 8825 for partnerships and S corporations. Sellers' closing statements also often contain transfer fees charged by the HOA. These transfer charges are part of the selling expenses, the same as county transfer taxes, realtor commissions, and escrow charges. If the taxpayer owns unproductive raw land in an HOA development, then HOA dues are classified as carrying charges, which are treated as 2% miscellaneous itemized deductions and are not deductible through 2025. In this scenario, tax professionals should consider making an IRC Section 266 election to capitalize property taxes and carrying charges. This election will allow the taxpayer to add the taxes and carrying charges for the property to their basis. The Section 266 election is an annual election that's made by attaching an election statement to the taxpayer's return. The election is required to provide a description of the property that's the subject of the election, as well as the date the capitalized taxes and carrying charges were paid or incurred and their amount. We ran an article on this topic in the May issue of Spiedel's Federal Tax Letter, and the article also included a sample election statement. For details on this monthly subscription, go to spiedel.com and click Publications. That's all for this week. Join us next time for another episode of Spiedel's Federal Tax Minute.